guys, welcome back to the Capital Mindset Show. We're your hosts, Austin and Fabio, and today we're going to be kind of having a conversation today about Stitch Fix, ticker symbol SFIX.
Is this a subscriber request?
It is. This is a subscriber request, and we're going to be going over this business. We're going to be going over what the business does, the products that it has, as well as some internal issues that we've been kind of seeing, and then maybe a little bit of other issues too, in terms of as to why their cash flows are currently negative right now. And then we're going to be plugging it into our discounted cash flow model, as well as looking at some key ratios for this company. So without further ado, what are we looking at here today?
So the first thing we're going to take a look at is just quickly some price movement, see what's going on. But I think they're down for the year. They had this high of 106. So let's take a look at the larger picture. Let's back out over here. So they're pretty much, if we're taking a look at the long term, they're up 122% since 2017, which is actually not that good. It's good, but it's not that good. There's definitely been other companies that perform better. However, I think what we can see here is something incredible happened during the year of 2020. So even if you bought here and you held on, you can see this level of exuberance that within less than a year, or that's about a year, just over a year, you generated a return of 224%. So we all know what kind of happened there. And that was the events that occurred last year, and the shutdowns subsequently were a huge boost, or a huge perceived boost, to their business model, which actually Austin and I, we can talk about now, just in case no one knows, but that's just an idea of the price movement and what we're looking at here. So some people might look at this and say, oh, there's a opportunity here because the price is down. Well, that's not necessarily the case, but we can kind of unpack that real quick. So Austin, explain to our audience what this business does. What is their goal? And yeah, we'll start with that for now.
Okay. So what the business does is that they pretty much, first and foremost, they give clothes based on a subscription. So what happens is you pay $20 for the initial subscription. They give you a set of clothes. You can try the clothes on, see if you like the clothes. Anything that you don't like, you put back into the box and you ship back to them. Anything that you do like, that $20 that you spent on the initial subscription box to arrive at your house, that $20 gets put onto a credit for you to pay for the clothes that you like, that you received from the box. So basically, I was kind of looking at this business model, and I thought that was a really, really interesting idea. Now, I went online, I did some digging. I saw some people who reviewed these products. I saw people in the exact demographic that this is really geared towards. They've indicated themselves that this product is primarily geared towards women. And I've seen women online saying that, oh, some of these clothes items are just too expensive. And now that's kind of interesting, because that brings up the concept of what is known as a price premium. So there's a price premium on these goods that they're sort of serving. Now I can see the use case here, especially for, let's say, a working, like, pregnant mother, something like that, someone that doesn't really have the time or the ability to go out and really shop for these clothes, and instead would love a model like this and where they can stay home, they can try on clothes, and then they can send those clothes back. But I also believe too that when it comes to shopping, part of the experience for a lot of people when they go shopping for clothes or whatever else is going to the physical place itself, trying on the inventory, not paying beforehand and then paying more on top of that. But hey, I mean, I don't really go shopping for clothes all that often, if I'm being completely honest with you. So that isn't exactly my area of expertise. But now, the thing about this company and the goal of what this company is really trying to accomplish is that they're trying, by using data analytics and using humans, they're trying to effectively sort of create a styler for each and every person to sort of have their own, it's like a convenient outfit styler, if that kind of makes sense there. So now my question is for you, how well do you think that they're really capitalizing on what they're doing right now? And if they're not, we can explore some of the ramifications of what they're not doing right now. So
Well, I would assume when we look at the numbers that they experienced a decent amount of growth in the last year. Okay, that's what my assumption is going to be before I look into this. As far as the appeal, I mean, I can see the appeal. Honestly, for someone like me who doesn't really shop very often for clothes, once in a blue moon, um, and one who doesn't actually enjoy to go and shop for clothes. I can understand that level of appeal, but you know, the point is with what they're trying to do is trying to make it easier. So like remove the plethora of choices because sometimes too much choice is overwhelming. So I go to the mall and there's so many different stores that I could go to. Sure, if for some people who are a little bit more into the fashion industry may understand this, they like this store over that store. They may have a preferred store. I don't really care. So for someone like me, it may kind of fit. Um, but not really. And as far as the target demographic, um, I think they have for everyone. I think they have for both men and women. I just don't
They
think
do. Yeah.
we need to see the user growth for
Mhm.
sure. That's what we need to see. And then we need to see on top of the growth, we need to see retention. Retention's equally as important as growth. So we need to make sure that the customers who are subscribing to the service are sticking to the service. And I actually kind of threw here, by the way, just to add some more flavor to what I was saying before. So actually, they did outperform the S&P 500 and the Total World Index Fund since their IPO, or over the course. Actually, I think it gives them an advantage because it's measuring them over 5 years, and there's this period over here where Stitch Fix wasn't public, so it wasn't able to compound. So someone could make that argument there. But this is a snapshot of 5 years. It could be that going forward that doesn't happen. But it's interesting to see because I would have actually thought that the S&P 500 did a little bit better, but apparently it was off by a little bit. So yeah, that's just for everyone to see there. But I think
Yeah,
actually let's.
and
Mhm.
something else that I actually noticed too. I was doing some digging into employee reviews of the company
Oh
itself and
yeah,
just
that's
sort of seeing what employees, people who had worked there had said. And a lot of the sentiment, at least post COVID, post 2020, a lot of the sentiment seemed really negative. It seemed negative towards management, it seemed negative towards the CEO, et cetera, so forth. Now we know the CEO is currently stepping down. I think she plans to remain chairperson of the board, where
really
she wants to, yes, actually, and she wants to sort of take more of a like a
passive role.
she yeah, but like also she wants to focus on really social efforts with the business and stuff like that and affecting social change, because that's really what her idea with this company was when she first started the company. But something that I noticed,
Define social change for me. Is she
I
specific on that?
honestly,
Or she
I
just
don't really
said
know.
social change?
She just said like social change. I don't really know what that means.
Uh,
It's not really something I really care to know what it means either. Because I don't really think I can make money from it, if I'm being honest. So I don't really care. But 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 yeah, basically a common issue that I kind of noticed with pretty much all of each one of these employee reviews is that they all said that there was an issue with inventory. Now, this is kind of reflected in their most recent quarterly filing in terms of their change in inventory levels. And they're all saying that like some of the inventory might be bland, some of the outfits are bland. They tend to get the same sort of outfits, but just in different colors. And that there seems to be this pervasive issue with inventory. Now, where my mind immediately goes to this is that a business such as Stitch Fix has to focus incredibly hard on making sure that it's managing its inventory correctly, because that's crucial to the business at hand here. But yeah, that was just kind of a thought that I kind of had as I was just doing sort of a preliminary analysis in this company
I mean,
itself. So
those are things we have to keep an eye on because management
yes,
risk is very important. Okay,
it is,
to
and
consider.
everybody on YouTube sleeps on it. It's crazy. I see
Yeah.
so many people on YouTube like not doing the due diligence into looking who the management are. Personally, if I'm being honest, when Fabio and I first started to invest together, that was sort of my favorite part, was just sort of into the management and just sort of like seeing like what management was doing, like who management was, like what decisions they've made in the past. And then also too, to see if we could find some slightly, at least in our opinion, it's not used for legal purposes, our opinion, nefarious things we might have seen. Now, I'm not saying there's nefarious things happening here at Stitch Fix. I'm not saying that at all. This is a completely side note to that, but just that management and looking into management is one of my favorite parts of just sort of capital mindset as a whole. So
yeah. And well, I mean, the other thing about management risk, management risk kind of comes after you analyze the financial risk. So I'll actually kind of shout out the channel. I think Everything Money. They talk about how they can follow like a checklist and they can quickly X stocks. And actually, that's a very valid strategy. So Xing stocks very quickly because the financials don't line up is very valid. Okay, so don't dismiss that. What we do in these videos is because these are subscriber requests, we kind of go a little further. And it's not that like I can look at a stock and tell between 30 minutes that I'm not interested. Between 10 and 30 minutes. And the quicker I can tell I'm not interested, it's usually like more glaring signs. But we go a little bit deeper in our preliminary videos because that's kind of like the brand that we're trying to build as well. To kind of go a little past that and show you the financials as well, so kind of like an overview and kind of give our thoughts on like the company itself, the mode, et cetera. So I'm actually segueing that. The reason why I'm mentioning mode is right now, what do you think the mode is? I mean, I think I'll give my opinion and yours. I think that the moat is limited, but it's still there because if they have an algorithm, right, and presumably they're utilizing some mechanism of machine learning, where I'm not gonna pretend to be an expert in their specific way of they're doing it, but presumably there's some improvements that can be made and they can learn from mistakes, et cetera. So that is building up a moat right there. And then on top of that, if they're building this brand awareness with the consumer base, branding is the moat. But as far as, Amazon not being able to come in, that's definitely not there. So they don't have the infrastructure advantage on Amazon. They have brand advantage on Amazon. And also with Nordstrom, I think Nordstrom owns Trunk Club. So I don't know if you've heard of them. And then there's another one that's like specifically for men. I don't remember the name of it, but it's these other services that exist, and they're kind of also competing with Stitch Fix, because Stitch Fix model is not too dissimilar from something like a Dollar Shave Club, where Dollar Shave Club you subscribe and you get your little products for shaving and stuff like that. But it's focused on clothes, a little more complicated because it's all unlimited variations of styles, sizes, etc. Shaving is very easy, but I think that with the infrastructure moat, there really isn't one. There is one, but it's not that big. It's not something that stops Amazon from coming in. And I think Amazon flirted with the idea. I'm not sure if the program is still going on, but I think it was something called like Amazon Stylist. If that's something you can actually quickly look up while when we're talking about this. But I think they might have.
I'll take a look at that.
I think they might have stopped that. But if they did, then that kind of shows to our audience that there is something here, or maybe the industry is just not attractive. That could be another explanation. So don't think that just because the company exited, that means that they just got beaten. It could also mean that it's not a long-term attractive business model. But it could also mean that they were kicked out, because
So now to answer your first question about what I think the moat kind of here is with Stitch Fix, I think that it's really just exactly that. I think it's the brand. And then I also think too, just sort of like a moat strategy for management to potentially contemplate employing would be to try to score deals with various high demand like I don't even know what this term is, styles, clothes styles. So like try to score fashion. Yes, and try to score very high, like try to score deals with very high in demand fashions, basically, and just that would be the strategy that I would try to employ with this, because that in and of itself further expounds on a brand moat. But now I also found something else with Amazon, and it's the Discover Personal Shopper here. So basically this is pretty much a here. This is pretty much here, just like exactly what we are not exactly what we're kind of looking at with Stitch Fix, because I mean, this is the first time I pulled this website up, so I can't claim to know, like, I can't claim to be an expert here. But as far as what I'm seeing here, this is very, very similar to sort of what Stitch Fix as a business is offering here. So curated just for you, tell us about your style. We'll pick pieces from thousands of brands to suit your taste and budget. So now Amazon, just bear in mind, this is a preliminary analysis. Now, what I would want to see Stitch Fix do, what I would want to see the management do, is basically try to score deals with very high in demand fashion styles, fashion icons, fashion brands. And then from there, what you can end up doing is that will cause your moat to expound, and that will really actually help the business moat in and of itself. Because right here, if Amazon keeps going with this, like, this could just, and then also too, if the costs are lower than what Stitch Fix is offering, this could have a pretty detrimental impact to the business, in my personal opinion. So,
All right, Austin, how much is Stitch Fix per month?
Well, I know that it's $20 per subscription. I don't know how much it is per month though. So
Yeah, that's the subscription per month.
It is, yeah. So it's just $20.
Yep. So you know how much Amazon's is?
Let me look.
I already got it for you.
You got it?
Yep.
How much is it?
$4.99.
Wow.
Yep. So now the question just becomes, can Stitch Fix have that brand awareness? Okay. So let me actually share with our audience more things that we found. So I think it's pertinent. Let me pull it up first before I claim that. I think they have it on their just their regular old website. Yeah, the different brands that they're partnered with already, because it's kind of following that strategy you said. So clearly right here, they are utilizing these brands within their platform. You can see some that are very well known, Levi's, jeans, Kate Spade, Nike, Under Armour, Columbia, Calvin Klein, etc. So if you can look through this and see if you recognize any of these brands, but maybe there are brands there that are missing that you are more interested in. So that could be something to think about. Amazon is probably more encompassing, perhaps, or utilizing different brands located on their platform. It may just be stuff that's already on their platform available to buy, but that's something to just think about there. As far as Stitch Fix presentation, let's actually look through this and see if anything really sticks out to us. But this is kind of going over the business model. It's not really anything to talk about, because I think we've done a decent job of explaining how it works. You do a subscription and you pay for what you keep. So then remember, this presentation is almost like a sales pitch. So take with a grain of salt, everything with a grain of salt here. But looking here, we can see the actually, let me make sure that everyone can see this. Online penetration, what they think is the total market, and then the online sales per se. So they're trying to tell you, hey, we're going to grow with the online retail market. Maybe that's some buzzwords you might think, because how much of that do they actually dominate? And this is including US and UK. And then they're doing their projections. So they're throwing out big numbers. What's the market cap of this company? Well, it's about $3 billion. So they're really trying to throw these large numbers to sell themselves a little bit. Again, they're talking about the organizational model. So you see they have the products, the brands over here, right? And then they have their own Stitch Fix brand. So this is important. If those can become hits, that's something to think about, all right? Because those are things that Amazon won't be able to replicate. Amazon can also make deals with Nike, UGG, etc. But can they make deals with Stitch Fix brands? So Stitch Fix cultivates, kind of like how Netflix made their own shows, and how no one else can, have Netflix shows, and how Netflix originally started was with third-party content. Well, if Stitch Fix has third-party products and then slowly can cultivate some brands, and maybe one or two become very successful, very popular, that can be a huge benefit to them. But that's an if, okay? And then here they're trying to say they're all encompassing with all these different types of customers, right? And none of this is really important. A lot of buzzwords with data, feedback data, merchandise data, client data. So big data basically is what they're trying to tell you. And then they're trying to make their ability of predicting what it is you'd like to be better and better and better. So their algorithm, again, is a moat as well. Their ability to be successful at that. Nothing that's really important there. Nothing that's really important there. I think we're pretty much done with this, except, oh, here. Yeah, I want to see like kind of if they have any projections. Looks like they don't, but we see gross margins going up, advertisement going down. That can be good or bad because maybe you want them to, take more market share, but depends. I want to see maybe more on the management if we do a deep dive on this company. But okay, so sales, SG&A is going up. Yeah, it's okay. But gross margin is going up. So that's good. Okay. It's not everything, but that's good. Okay. So active clients, remember I said that we need to make sure that's going up. So, okay, 2020 was a huge year. So difference between 2020 and 2021, massive jump from compared to 2019 to 2020. I can understand why their stock price had such a huge run up. We need to see if they can keep that. And there you go. Net revenue per active client, very important as well. So about $505 per client. So you can see here how the active clients grew from 19 to 20, but the net revenue per client went down slightly. So that's another way you got to keep in mind, because what happens if active clients grows by a certain amount, but the net revenue per client declines by such a great amount, right? So not many people are buying or whatever. That can be a problem. So you want to pay attention to that as well. I love how they put just like negative nothing. Well, I guess because they didn't want to put the decimals. It's a really small amount.
Yeah.
Okay, so revenue is jumping up nicely. But we want to see more than just revenue growth. We can start $100 million. Yeah. We can start $100 million business today if we have $200 million. We can go to every single customer and offer them $2, right? If they give us $1. And there you go. We have $100 million business overnight. So yeah, that's just an analogy of what I'm describing here. And then, this horrible number, EBITDA. Fancy speak for when a company's not profitable. They will always highlight EBITDA. Always, I'm not accusing SFIX of this, but like, be very wary when a company highlights EBITDA. All right, there's a purpose for EBITDA and why it was made. Should I go into that in this video?
Yes. Sure. Yes, I would.
So, do you know why EBITDA was utilized, Austin, by chance?
Isn't it something to do with the credit market and creditors assessing the risk of a particular investment using EBITDA? Wasn't that originally why it was founded?
Yes. Yeah. So the purpose of EBITDA is under the assumption that I'm going to be paying off all the debt and that you're going to dividend out all the cash that's on the balance sheet. So then you do EV to EBITDA, right? Kind of valuation metrics, because I'm acquiring the entire business. But as far as an investor goes, if I'm not acquiring the entire business, the relative measure or metric of EBITDA is rather worthless. So it was actually formulated in around the 80s with regards to a lot of M&A activity. So you would say the EV to EBITDA valuation of a business is X, and you're going to buy the entire business and you're going to pay off all the debt, and you're going to make the company's going to give out all of its cash on hand to the shareholders. So that was kind of like the purpose. But if you're buying one share, that doesn't really matter, right? Because that's still there. So EBITDA is removing from it a lot of real expenses, such as interest. So interest and taxes are real expenses. So you need to take into account tax. You need to take into account interest for actual projections. Because like, if you want to reflect the amount of money that you can actually take, well, the taxes actually take cash from the business. All right, that's a real expense. It's different from the cash flow metrics, which do still account for taxes and interest, right? Depreciation, amortization, you want to be careful with that because those are actual expenses as well. And as an accountant, you'll appreciate that because you want to, that's the purpose of reflecting them in depreciation, is because the asset that you acquired is losing its residual value over time. So you want to reflect the cost of buying it, right? Now, if you make a gain on that, there's like, other tax implications that you can actually generate a gain and if you depreciate down, but that's not the video for that. But basically you want to be careful with EBITDA in summary. So a little spiel about EBITDA in the Stitch Fix video. Okay, so we want to take a look here, what they're reporting. Cash has gone down. Maybe they did some investments, so not necessarily a bad thing. And I know they're not profitable, so they're probably bleeding cash, but they still have cash. Total assets, okay. Working capital, okay, stayed about the same. Total liabilities went up. Probably they took on some debt, maybe. We'll find out. Yeah, nothing really sticks out here. Negative net income, negative interest expense.
No, this is all stuff that we can find in our model anyways.
Yeah. So let's actually just go straight there.
Yeah.
All right. So
oh, would you fix the screen a little bit too? Yeah, there we go.
No worries. I got you. All right. So
perfect.
Right here, let's take a look at the ratios to start out. So actually they got no debt.
So it's probably share dilution, if I had to guess then.
They're probably funding themselves with some equity because and that kind of makes sense because again, as a learning moment, we want to make sure that the company is utilizing the most effective form of funding. In this case, I bet you that the credit markets is a little more expensive than the equity market. And it makes more sense for the CFO or the management itself to issue new shares to raise capital and invest that rather than taking on debt. And debt is a real risk. And it's one of the main reasons why companies go bankrupt. Versus equity, what you're doing when you issue shares is you're giving up future income. So the cost can actually be exponentially greater because the debt can be a fixed amount. It's the principal plus the interest, but the equity that you're giving up, while it has no maturity date, it has a infinite potential, right? Because in theory, the company has infinite potential to grow and you're giving up share or percentage ownership of that infinite potential. So it's kind of like double-edged sword you got to think about, okay? But in the moment, I guess management made that decision.
Exactly. Yeah, it just really helps provide further color into how we like to think at these sorts of things, So it's not so much of a cut and dry approach. There's a lot of different factors that sort of go into each one of these. Investing is a multifaceted, multi-layered cake. So
with operating margins, we do see those as negative. That's not a good sign. We do see a decay of it, which is interesting. That would be something in a DD.
Yeah, there are probably some pretty serious scalability issues happening here right now.
Yeah, probably.
I bet you a lot of that.
None of this really matters.
We would confirm in a DD. I bet you a lot of that would be advertising. But again, I don't know. I don't have the financial statements in front of me right here. That would be something that we would see in a DD. So,
I mean, I think the SG&A, they had it right there. Already talked about it.
Yeah.
It was just to revisit it. Yeah, SG&A went up.
Yeah.
So there's your answer, or that's part of your answer. Okay, so nothing really sticks out here. Just, some things have been getting worse, like the cash conversion cycle. Yeah, nothing really sticks out here. So then let's actually go over to the final valuation. So if we're assuming let's assume first a market rate of return. And let's not assume any share dilution, no buybacks, nothing. Then we're actually looking at something interesting if you're going to be assuming around I think you can assume probably an 18 or 19. Okay, very close. So bet you in 19. Yep, there we go. So 18% rate of growth rate in the business operations. And this is under the assumption that over the long term, they're going to achieve similar cash flows to something like American Eagle. Okay, so that's what we utilized that's what the model is assuming. It's taking the industry competitors like American Eagle, Abercrombie and Fitch, and then applying it to the business and then making the assumption that it will reach there one day. So under those assumptions, that's kind of what we can get at if you can assume these growth rates. So with this, because it's not proven itself yet to be capable of being cash flow positive, I would want a very high discount rate. Okay, a very high discount rate, which in that case, 10% just won't cut it, not even close. So 20% and above, okay, is what I would be looking for. And I mean, if you're bullish on this company, I know you're already mad at me. You're like, oh, how dare you? How dare you show a price of $11? Because I think the projections for this growing is like 20 to 18%, somewhere around there. So this is kind of more in line with what projections are at right here. This is being very aggressive, and I have
Well, I
to
mean,
assume,
also it is a 20% required rate of return too. So
but I have
it's not,
to,
yeah, and
because
it's not surprising to me that the model is going to print out lower numbers with a higher required rate of return. But there's a lot of people too that might not understand that that's typically just the mechanism of the way that a discounted cash flow model functions in and of itself too. So
yeah, let me check to see some of these measures. I mean, yeah, they're not at risk of bankruptcy because of the debt. There's no dividend as well. Yeah, ignore this because we don't care about that right now. But we do in the sense, but it's not a big deal here. The book value I don't care about, like I said. Yeah, nothing really here sticks out. So this is kind of where I'm at. I think for this business, this is one that I don't quite understand or feel comfortable with adding to my portfolio, simply on the basis that I cannot fully grasp the true risks associated with it. And because I cannot project truly when the cash flows are going to be positive, it falls into the too difficult bucket for me. For those of you out there, I can play around with this real quick and kind of give you an idea of what you're looking at. But if for example, you think they're going to be growing at 40%, let's say 35%, let's be aggressive here to showcase that. 37%. So that can give you an idea of what you can kind of expect if you would require a 20% rate of return. I want to see that they dilute me over time. They did. So then let's now assume a dilution package of around -2%. Okay, so if they continue to dilute at what they've historically done, that increases the requirement that you need to expect in terms of growth rates in order for you to achieve a 20% rate of return.
Something else that I actually want to bring up too, just for a quick second here, and that kind of goes into the potential dilutive effects of everything. No, you know what? I don't need to share my screen for this. So there's actually two classes of common stock, like we just found.
Exactly. The model
Class B is actually convertible to Class A. So during a deep dive analysis, I would want to see who the holders of Class B common stock are. I have a theory. Founders. Yeah, and I have a theory in my head of who that might be, but I would want to see also as well how often they're sort of exercising these conversion rights, because that would have a direct impact on me as well as a shareholder in this particular entity. But that was just another, little nugget of knowledge I wanted to throw in there.
The only concern that you should have with classes of stock is when there's separate economic interests. That's it. Voting interest, you can kind of get past. But if you separate economic interest, that's where things can be hazy. I refer to our Rocket video on Rocket Mortgage as far as what that kind of structure can look like as an American VIE. And in fact, we're going to come out with a video soon again on Alibaba, going further again, revisiting that topic, because there's a lot of people, we've gained a lot of subscribers since those videos, and we want to revisit those topics. But with two classes of stock, I don't think SFIX off the top of my head has a separation of economic interest. They probably have a separation of voting interest, as in the other class. Okay, so you see, so that's nothing to be concerned about. You still have equal economic interest rights. So the incentives aren't against you for management. And if they dilute you or they dilute themselves, they're still diluting themselves of economic interest, which is what at the end of the day is mostly what's important. But voting power is also important. I understand that too, because some of you out there might be saying, well, the value of my shares is more valuable if I have control. That's true. Okay. But yeah, for the two classes of stock, I don't really feel concerned. So this is kind of where I'm at. It's too complicated for me. Austin, what are your thoughts? Closing thoughts?
I think the business is definitely interesting. I
Oh
think
yeah.
it's a cool concept, and I think that if they find their correct niche and their niche is actually scalable, that this business could potentially do well. But as of right now, I'm not entirely too sure. I see management's vision for where this business could go, and especially when it comes to a business like this, I like to see that employees are saying, I believe in the management and where this management could take this company, if I'm seeing kind of this story that it's telling me right now in these financial statements. But as of going forward, as a case study, I would be definitely interested to kind of see, kind of go into Stitch Fix a little bit deeper. But in terms of making it a part of my portfolio now, I would have to pass as of right now, but that might change in the future, and I'll keep an eye on this one. What about you?
Well, no, I already said it.
Yeah. Yeah.
So
Yeah.
yeah, I'm good for now.
Perfect. Well, with that being said, you've heard it here, folks. We are your hosts, Austin and Fabio. If you've liked what you've seen here today, please be sure to share the video. It really helps out the channel. Also, please be sure to visit our website at www.capitalmindset.org. And then you can scroll all the way down and then ask us to do a stock analysis, a preliminary or a deep dive analysis. As always, we are not registered nor licensed financial advisors, so we will not be offering personalized financial advice. But with that being said, please be sure to like, comment, and subscribe, and see you guys later.